Okay, so if I told you I just found something yielding like 21% right now, you'd probably think I was seeing things.
Yeah, 21%. That definitely sounds
Yep.
suspicious.
Yeah,
Or maybe too good to be true.
exactly. Our source for this deep dive nails it, saying a yield that high sounds like either divine intervention or a trap laid by the devil himself. And I mean, that was my first thought, too.
It's just so far outside the norm. We're seeing maybe 5% on treasuries being a big deal. So 21%, it just screams, look closer. You have to ask questions.
You really do. And that number, that 21%, is really the hook for the article we're digging into today. It focuses on this specific investment, ECC, Eagle Point Credit Company.
Right.
So our mission here is basically to unpack what the source tells us about it. What is ECC? How does it possibly get that yield? And crucially, what are the big risks involved?
We're using ECC as a kind of case study,
Yeah.
to explore this really complex, sometimes murky area of finance.
Yeah, the source calls it the messy world of high-yield debt, leveraged loans, Wall Street voodoo.
Yeah.
Fun stuff.
Definitely. And the goal is to see if the market can sometimes hand you a gift, but,
Yeah.
well, the source says it's probably wrapped in barbed wire.
Okay, let's get into it then, starting right at the beginning. ECC. What is it, fundamentally?
Yeah, okay. So ECC, ticker ECC, it's a closed-end fund, a CEF.
Right.
And its main thing, its core investment, is pretty specific. It buys the equity tranches of CLOs. That stands for collateralized loan obligations.
CLOs. Okay, that term. It might make some people a bit nervous, maybe thinking back to 2008.
Yeah, they definitely got a lot of attention back then, often negative. But the structure itself, isn't inherently evil. A CLO is basically a big pool of loans.
Loans to companies?
Usually, yeah. Loans made to companies that are often below investment grade, so maybe riskier, smaller companies than the big household names.
All right.
And this big pool of loans gets sliced up and sold off in pieces. They call them tranches.
Like slicing a cake, but maybe some slices are safer than others.
Exactly like that. You've got senior tranches at the top. They're lowest risk because they get paid first from the loan payments coming in.
First dibs on the cab.
Right. They get their money back before anyone else lower down the stack.
And ECC, I'm guessing it doesn't hang out with the safe slices.
No. It skips right past those. ECC focuses on the equity tranches. These are right at the bottom.
The bottom. Okay, what does that mean in practice?
It means they get paid last. So if there are any losses, if companies start defaulting on their loans in that pool, the equity tranche takes the hit first. It's the buffer.
Ah, okay. So any trouble at all with the underlying loans, the equity investors feel it immediately.
Immediately and hardest.
Yeah.
Last for cash, first for losses. But, and this is the key part.
There's always a but.
Right. Because they take on all that risk, they also get the potential for the highest returns. If the loans perform well and there's plenty of cash left after paying everyone else.
The equity tranche gets the juicy leftovers.
Exactly. The juiciest potential returns are down there.
Wow, okay. That really drives home the source calling it not a game for the faint of heart. It even contrasts it, like buying a safe dividend ETF, SCHD maybe, is sipping decaf. But ECC is like shooting espresso straight into your veins.
That's a pretty good analogy, actually. You're right at the most volatile, riskiest point in the structure for these types of loans.
Okay, this is where it gets really interesting, though. Let's talk about that number, the one from the source that just jumps out, the 21% yield.
Right. So according to the article, ECC is currently distributing $0.16 per share. And importantly, it pays that monthly.
Monthly, okay.
If you multiply that by 12, you get $1.92 per share for the year. And the source noted that based on a recent share price around $9, we'll do the math, that's a forward yield over 21%.
Over 21%, wow.
It's, like the source says, so high that it practically demands a wellness check on your portfolio.
It really does. And the obvious question, the one everyone should be asking, and the source hits it directly, how is this sustainable? Is ECC just giving people their own money back? Is it liquidating?
Yeah, that's the million-dollar question, isn't it? And the source says, well, it's complicated. The money for those distributions comes from how well those underlying CLO equity positions are doing. If the loans in the CLOs are being paid, cash flows through the structure and potentially down to ECC.
Right.
ECC then distributes a chunk of that cash flow to its shareholders.
But we just established CLO equity is volatile. Those cash flows can't be steady.
Absolutely not. They aren't smooth at all. Loan defaults can go up. Interest rates change things. The market for these loans can get choppy. So is 21% sustainable forever? The source suggests probably not, indefinitely.
All right.
But Could it be sustainable for the next, say, 12 to 18 months based on how things look right now? The article suggests maybe yes. And a really key point the source makes is that even if they had to cut the yield maybe down to, I don't know, 16%, that's still incredibly high. So a cut wouldn't necessarily kill the whole reason someone might invest in it for income.
Right, so maybe not sustainable forever, but potentially sustainable for a decent while under current conditions. And even a haircut wouldn't be catastrophic from such a high level.
That sums up the source's take pretty well.
Yeah.
It all hinges on things staying reasonably stable in those underlying loan markets.
Okay, so sky-high yield, risky assets. Who's actually flying this thing? Is there a solid team in charge here?
Yeah, the source talks about the management team at Eagle Point. And they're described not as, like, general fund managers who dabble in this,
Right.
but as specialists, people who live in the CLO trenches. They really know this specific kind of niche market. The lead manager mentioned is Tom Majewski.
And do they have a track record? Have they navigated rough seas before?
The article says yes, they've weathered storms before, specifically calling out the COVID crash, which was a huge test for credit markets.
For sure.
And they seem to adjust their strategy based on conditions. They actively pick CLOs, rotate the portfolio, reinvest when opportunities pop up, and they use leverage.
Leverage. There's that word again. Adds a bit of spice.
It definitely does. The source notes they use it carefully, but then adds the caveat that, carefully is a bit relative when you're already dealing with volatile stuff like CLO equity.
Good point. Careful leverage on something already risky is still risky leverage?
Pretty much. Leverage boosts returns when things go well, but it also makes losses much, much bigger when things go wrong. It cuts both ways, hard.
The source also mentions they're shareholder-friendly, but in a funny way, like a crazy uncle who gives you a wad of cash every Christmas? What's that about?
Yeah, I think that relates to their distributions, the monthly payouts, sometimes throwing in special dividends when the CLOs are really performing well.
Okay.
And apparently they try to communicate actively with their shareholders, which is important given how complex this stuff is.
Yeah, transparency seems key here. Knowing the managers are specialists and talking to investors probably helps build some confidence, right?
It definitely helps, especially when you're investing in something that isn't, simple, like an S&P 500 index fund.
Okay, we've sort of tiptoed around it, but let's face the herd of elephants in the room, as the source puts it, the risks. Given the assets, the leverage. What makes this potentially so dangerous?
Yeah, the source is blunt here. ECC is risky because CLO equity is risky. And then the fund adds leverage on top. It's risk on top of risk. The summary, financial equivalent of juggling chainsaws on a unicycle.
Oof. Okay, let's try not to drop those chainsaws. What's the first major risk?
Risk number one, credit risk. This is the big one. It's the risk that the companies whose loans are inside those CLOs start defaulting. They stop paying.
Right.
And remember, the source says these often aren't huge, stable companies. They're companies you've never heard of doing things you don't want to Google if enough of them default.
The cash flow dries up.
Exactly. Less cash coming into the CLO means less cash potentially flowing to the equity tranche, which means less cash for ECC's distributions. That 21% yield depends directly on these often risky businesses paying their debts.
Okay, so that's fundamental. What's next?
Second, leverage. We touched on it. ECC borrows money to invest more. Great when returns are high. But if the income from the CLOs drops, those fixed borrowing costs suddenly eat up a much bigger slice of the pie. It magnifies losses hugely. Things can, as the source vividly puts it, turn sour faster than milk in a heat wave.
Magnifying losses on already risky assets sounds like a recipe for sharp downturns.
It absolutely is.
Yeah.
Third risk, liquidity risk. Okay, so ECC shares trade on an exchange, but the source warns they can be volatile, and sometimes not many shares trade hands each day.
Meaning it could be hard to sell if you wanted to.
Especially in a panic. If everyone rushes for the exits, the price could drop really fast. The source says 10-20% in a heartbeat. You might not be able to sell quickly without taking a big loss.
Yikes. So the price you see isn't always the price you can get out at easily.
Precisely. And finally, number 4, NAV transparency. This is interesting.
Yeah.
The net asset value, or NAV, basically what the fund's underlying assets are actually worth.
Yeah.
It's only calculated and reported monthly, not daily like a lot of mutual funds or EPFs.
Monthly? So what happens in between?
Well, the source puts it starkly. In a crisis, you're flying blind. If the market for CLOs tanks, you won't know how badly ECC's portfolio has been hit until that monthly report comes out, potentially days or weeks later.
Oh, wow. So risk of defaults, amplified by leverage, Hard to sell quickly in a panic, and you don't even know the real value day to day. That is quite a risk cocktail.
It really is. It demands an investor who truly gets these risks and is okay with that level of potential volatility and, frankly, uncertainty.
Okay, so despite all of that, the author of the source article, they actually bought ECC. Why? What's the thinking behind taking on that much risk?
Well, the source is pretty clear. The author's main goal isn't trying to, time the market or predict the next big thing.
Right.
Their focus is building a portfolio that generates significant cash flow, income, money they can reinvest or eventually live on.
And 21%. Well, that throws off a lot of cash.
Exactly. For the author, that super high yield creates a big margin of error. Their thinking, according to the source, is like this. Even if things weaken, and ECC has to cut the payout maybe down to 16%, which is still huge, they're still golden for their income goals from this particular investment.
Ah, I see.
And if the share price gets knocked down because of market jitters, that high yield makes it potentially attractive to buy more, assuming the underlying CLO market isn't actually falling apart.
So the bet isn't on smooth sailing. It's more like the income stream is so high it can absorb some bumps.
Pretty much. The source says they're betting on decent CLO performance, rational credit markets, and capable management. It's a bet on the niche and the managers, not on broad market predictions.
Okay, it's less about predicting the future and more about capturing this specific high but risky income stream right now. The source specifically says they aren't betting on things like meme stocks or hoping some AI startup turns into the next Tesla.
Right. It's a totally different game. It's about maximizing current cash flow, even if it comes with volatility, rather than chasing capital gains from growth.
Which brings us right to the dividend trap idea. You hear that all the time, right? Anything yielding over, say, 5% or 6% must be suspicious, maybe about to collapse. Is ECC just that? A trap?
That's a critical question. And the source argues pretty strongly that not all high yields are traps.
Okay.
Think about a typical dividend trap. It's often a company whose actual business is failing. They keep paying a dividend, they can't afford to look healthy, but the stock price is plunging because the business is broken. The high yield is just mathies. The dividend divided by a falling price.
Right. The yield is high because the price is low due to problems.
Exactly. But the source argues ECC's high yield isn't because the fund itself is fundamentally broken or desperate. It's high because the asset class that holds CLO equity is inherently risky, complex, and volatile. And because it's risky, the market demands a high yield to compensate investors for taking that risk. The high yield is the price of admission for playing in that risky sandbox, so to speak.
So the yield reflects the asset's risk, not necessarily the fund's distress.
That's the core argument the source makes. It calls ECC risky but rational for the right person. It's a high-octane income machine with greasy parts and exposed wires. The design isn't broken, it's just intense. And definitely not a smooth ride. The market prices that intensity in.
That distinction makes sense. It's risky by its nature, not just because it's failing. What about the actual payout history? Has it been steady, or does it reflect that bumpiness?
The source says the history is bumpy, but it's honest, which I think is a good way to put it. They have paid monthly since they started, which gives some rhythm.
But the amount paid each month, that changes.
Yes, and that's crucial. The source highlights that management has adjusted the payout based on the actual cash flow coming from the CLOs. They cut it during the worst of the COVID panic.
Understandable.
But they've also increased it and paid out special dividends when the underlying assets were doing really well. The source sees this flexibility as a positive. They aren't just pretending everything's fine and maintaining a payout they can't afford.
Right, they adjust to reality, which seems necessary for an income stream that's naturally variable. Trying to keep it fixed might mean eating into capital sometimes.
Exactly. The payouts kind of mirror the ups and downs of the CLO equity cash flows.
Okay, practical stuff now. Taxes, always fun. How does ECC handle that?
Well, first, the good news, according to the source.
Yeah.
ECC sends out a standard 1099 form, not a K-1.
Oh, thank goodness. No K-1s is always nice. The source calls it a K-1 free zone.
Yeah, that definitely simplifies tax time for most people.
But there's always a but with taxes, isn't there? What's the catch?
The potential catch is that a good chunk of the money you get paid each month might be classified as return of capital, or ROC.
Return of capital? Sounds like getting my own money back.
Sort of. The source explains ROC isn't automatically a bad thing in a closed-end fund like this. It can be a normal part of how they manage distributions.
Okay.
But for you, the investor, it's different from receiving, say, earned interest, or qualified dividends. It's cash in your pocket, yes, but for tax purposes, it reduces your cost basis in the investment.
Reduces my cost basis.
Meaning the original amount you invested is considered lower for tax calculations down the road. The source is clear. It's not free money. You get cash now, but the tax impact is generally deferred. When you eventually sell your shares, that lower basis means you'll likely have a larger capital gain to pay tax on or a smaller capital loss.
Got it. So cash flow today, but need to track that basis because it affects taxes when you sell. A bit more bookkeeping involved.
Definitely requires keeping good records.
So with all this complexity, the risk, the tax wrinkles, where does the author actually put ECC in their portfolio? Surely not front and center.
No, definitely not. The source is very explicit. ECC is not a core holding. It's not the foundation.
Okay, so more like a special teams player.
Yeah, something like that. It's called the tactical income play. It sits in what the author calls their high-yield satellite group.
High-yield satellite.
Yeah, alongside other kinds of investments that are maybe a bit volatile or complex but pay well. Things like BDCs, business government companies, or maybe some REITs. The source calls them misfit toys.
Misfit toys. I like that. Messy, maybe, but they serve a purpose.
Exactly. Volatile, maybe messy, but potentially throwing off a lot of income if you manage them carefully. It's a deliberate, smaller allocation aimed purely at boosting the portfolio's overall cash flow, accepting the higher risk.
Makes sense. And does the author have conditions for keeping it?
Yes, very specific ones mentioned in the source. They'll hold it as long as, 1, the distribution seems covered by the cash flow coming in.
Yeah.
2, management stays transparent and competent. 3, the whole CLO market doesn't, implode.
Right. Need the underlying market to hold up.
And interestingly, 4, if the price doesn't shoot way up, if it moons, as the source puts it, they'd likely sell some to big profits.
So even for the author, it's not a set it and forget it investment. It needs watching.
Constant monitoring, absolutely.
Okay, let's wrap this up then. Thinking about you, our listener, if you've heard this and that 21% yield sounds tempting, what's the bottom line from the source? Who is ECC definitely not for?
Based on this analysis, it's absolutely not for someone just chasing yield without understanding the why and the how. Definitely not for someone who panics when markets get choppy or prices drop.
Yeah.
If seeing your investment value swing wildly or not knowing the exact NAV day to day makes you lose sleep, stay away. And obviously not for a conservative investor focused on capital preservation. This is not that.
Okay, clear enough. So who might consider it then, according to the source?
Someone who really digs in and understands the risks, credit risk, leverage, liquidity, NAV, opacity. Someone who gets how CLO equity works, someone who can genuinely handle big swings in price and potential payout cuts without freaking out. And someone whose main goal is boosting their income stream significantly and is consciously willing to take on substantial, understood risk to achieve that. The source really sums it up well. The yield is insane, management seems competent in this specific area, the risk is very real, but maybe, just maybe, the payoff might just be worth it for that specific kind of informed, risk-tolerant investor.
It definitely sounds like homework is required. You need to understand it deeply and know yourself, your own tolerance for risk. It could be, as the source says, a dangerously alluring siren song. That monthly cash flow is powerful. But are you really ready for your heart rate spikes with every earnings call? That's the question the source leaves us with, isn't it?
That's the core question, absolutely.